So under fundamentals of revenue recognition, so we have the new revenue recognition standard, and that is PFRS 15 for implementation this year. And we have also examples here. And the 5-step process, we're going to revisit it. And how do we make, or how do we prepare journal entries in the recognition of revenues, including presentation and disclosure in our financial statements. So for the background, both IASB, the International Accounting Standards Board, and the Financial Accounting Standards Board of the US have indicated that the state of reporting for revenue was unsatisfactory. That's why the International Accounting Standards Board issued a converged standard on revenue recognition titled Revenue from Contracts with Customers. And that's also the title of our chapter. So the revenue from contracts with customers adopts an asset liability approach. What does it mean? So under this, companies account for revenue based on the asset or liability arising from contracts with customers. Companies are also required to analyze contracts with customers because these contracts are the lifeblood of most companies. So why asset liability? Because we don't immediately recognize revenue. Can you still recall your unearned revenue before? Take note that the account unearned revenue is always a liability. So while we receive the money and yet we haven't performed the services yet, then the transaction is an asset liability, to be specific. So we don't immediately recognize revenue class under the new revenue recognition standard, because there are still transactions to be completed. And with that, we're going to follow the 5 steps of revenue recognition. So what is the key objective here? Recognize revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration that the company receives or expects to receive in exchange for these goods or services. And we have the 5-step process for revenue recognition. First, identify the contract with customers. Second, identify the separate performance obligations in the contract. Third, determine the transaction price. Fourth, allocate the transaction price to the separate performance obligations. And fifth, recognize revenue when each performance obligation is satisfied. Under revenue recognition principle, recognize revenue in the accounting period when the performance obligation is satisfied. So the bottom line here, class, is simply understand whether the performance of a particular obligation is satisfied both by the seller and the customer, not or. It should be Both, because there should be an agreement with regard to contract. So we have an example here. Assume that Airbus from France, of course, corporation signs a contract to sell airplanes to Cathay Pacific Airlines, Hong Kong, for 100 million euros. So first, step one, identify the contract with customers. So what is this? A contract is an agreement between two parties that creates enforceable rights or obligations. In this case, Airbus has signed a contract to deliver airplanes to Cathay Pacific. So that's one of the largest airlines in Hong Kong. Second, identify the separate performance obligations in the contract. So there's only one performance obligation to be conducted by Airbus. Only the delivery of airplanes. If Airbus will also agree to maintain the planes, a separate performance obligation is recorded for this promise. So we're done with step 1 and 2. Step 3 is determine the transaction price. So that is 100 million. Number 4, allocate the transaction price to the separate performance obligations. In this case, there's only one performance to be undertaken by Airbus. That is simply the delivery of airplanes to Cathay Pacific. So there are other examples as we progress in our discussion. And then step 5, recognize revenue when each performance obligation is satisfied. So the airplanes were delivered and Airbus was paid, or Airbus received the money. So in this example, Airbus recognizes revenue of 100 million for the sale of the airplanes to Cathay Pacific when it satisfies its performance obligation, which is the delivery of the airplanes. So another example here, identifying the contract with customers. Step 1, assume that Tyler Angler orders a large cup of black coffee costing $3 from Bean. Tyler gives $3 to a Bean barista who pours the coffee into a large cup and gives it to Tyler. Question, how much revenue should Bean recognize on this transaction? So just like when you go to Azai coffee shop and you order for a mango juice or a coffee, or when you go to Starbucks and you pay 150 pesos for a particular coffee, this is a similar class. So how much revenue should be recognized on this transaction? Step 1, identify the contract with customers. So we need to memorize this class, the 5 steps. Not only familiarizing it, we have really to memorize it. So the contract has a commercial substance. So the customer gives cash for the coffee. And the parties have approved the contract. So Tyler agrees to purchase the coffee and Bean agrees to sell it. Then identification of the rights of the parties is established. So Tyler has the right to the coffee and Bean has the right to receive the $3. Step 4, Payment terms are identified. So an agreement between Tyler and Bean that Tyler will pay the $3 for the coffee. So it is probable that the consideration will be collected. Bean has received the $3 before it delivered the coffee. Just like when you go to Azay again in Undayan, you cannot take out the pizza or whatever before paying it in the counter. If you were there weeks ago, you can experience that. So here in this scenario, under step 1, identify the contract with customers, it appears that Bean and Tyler have a valid contract with one another. So step 2, identify the separate performance obligations. There was only one. What was the obligation of Bean? To provide a large cup of coffee to Tyler. And Bean has no other performance except to provide really the coffee, to pour the coffee. And the transaction price is $3 and there are no discounts whatsoever. So there's only one performance here, so no allocation is needed. And then after satisfying the performance obligation, Bean should recognize $3 in revenue from this transaction when Tyler receives the coffee. So still under step 2, the following day, Tyler orders another large cup of coffee for $3 and also purchases 2 bagels at a price of $5. The barista provides these products and Tyler pays $8. Question: how much revenue should Bean recognize on the purchase of these 2 items? How much, class? How much? It is specified here. 2 bagels at a price of $5 and 3 for a large coffee. So you knew the answer now. So we have an example of the 5-step process here. So identify the contract with customers. A valid contract exists as it meets the 5 conditions necessary for a contract to be enforceable, as discussed in our previous example. So Bean must determine whether the sale of the coffee and the sale of 2 bagels involve 1 or 2 performance obligations. So let us continue. So multiple performance obligations exist when the following 2 conditions are satisfied under step 2. So Bean must provide a distinct product or service. So it appears here that Bean's products are distinct with the contract if the performance obligation is not highly dependent on or interrelated with other promises in the contract, then each performance obligation should be accounted for separately. Are the bagels and cup of coffee highly dependent, or are they interrelated? So that's a question we need to answer. So in this example, Bean has 2 performance obligations. Determine the transaction price. Just like earlier, we were asked, how much is the revenue to be recognized by BIN? So the transaction price is 8. That's 3 plus 5. Step 4. Allocate the transaction price to the separate performance obligations. In this example class, BIN has 2 performance obligations. Each obligation is distinct and not interrelated and priced separately. Therefore, no allocation of the transaction price is necessary because it was given. So the coffee sale is recorded at 3 and the sale of the bagels is priced at 5. Step 5, recognize revenue when each performance obligation is satisfied. So BIN has satisfied both performance obligations when the coffee and bagels are given to Tyler, who has the control of the product, no? And the control has already passed to the customer. So the total amount must be 8. Okay, determining the transaction price under step 3. BIN is interested in stimulating sales of its smoke jumper coffee beans on Tuesdays, a slow business day for the store. Normally, these beans sell for 10 for a 12-ounce bag, but BIN decides to cut the price by 1 when customers buy them only on Tuesdays. So the discounted price class is now 9 per bag. Tyler has come to the store on a Tuesday, decides to purchase a bag of smoked jumper beans and pays BIN 9. How much revenue should BIN recognize on this transaction? So as what earlier required, we identify the contract with customers. So we have the definition here. Second, identify the separate performance obligations. So the performance of BIN is to provide a bag of smoked jumper coffee or coffee beans. So in this example, BIN has no other performance obligation to provide a product or service. Step 3, determine the transaction price. So the transaction price is 9, not 10, because this was on a Tuesday, and every Tuesday they are discounting it by $1. So there's a reduction of $1 because there are only few customers every Tuesday. So step 4, allocate the transaction price to the separate performance obligation. There's only one here, so no allocation is necessary. And step 5, BIN has satisfied both performance obligation. So in this example, BIN should recognize $9 only of revenue when Tyler receives the smoked jumper coffee beans. Allocating the transaction price to separate performance obligations. Step 4. So transaction price is allocated to the various performance obligations based on their relative standalone selling prices. So just like here, it offers customers a $2 discount on the purchase of a large cup of coffee when they buy a bag of its premium motor mocha beans, which is normally sell for 12 at the same time. As indicated earlier, a large cup of coffee normally retails for 3 at the coffee shop. So how much revenue should be recognized on the purchase of these 2 items? So we go back again, step 1, then step 2. So there are now two performances here. A bag of the mocha beans and a large cup of coffee. They are distinct from one another and they are not highly dependent on or highly interrelated with each other. Step 3, determine the transaction price. So the transaction price is 13. How did we get that? That was given in the example. And allocate the transaction price to the separate performance obligations. So the store or the shop is allocating the two performance obligations based on the relative standalone selling prices as follows. So here, beans, 1 bag, the standalone selling price is 12. Percentage is 80%, that is 12 over 15. And the percentage, 80% times 13, so that is 1040. And large cup of coffee, $3, that's 3 over 15, that's 20%. So bean allocates the transaction price to the two performance obligations based on their relative standalone selling prices. Step 5, recognize revenue when each performance obligation is satisfied. So bean has satisfied both performance obligations as control of the bag of mocha beans and the large cup of coffee has passed to Tyler. So therefore, bean should recognize revenue of 13, comprised of $10.40 for the mocha beans and the sale of the large cup of coffee at $2.60. So step 5, recognize revenue when each performance obligation is satisfied. So it has been said that when Tyler obtained control of the products, it means that the performance of obligation was complete. So indicators that Tyler has obtained control are as follows. Bean has the right to payment for the coffee. Bean has transferred legal title to the coffee. Bean has transferred physical possession of the coffee. And Tyler has significant risks and rewards of ownership. And finally, Tyler has accepted the asset. So under contract, that is simply agreement between two or more parties that creates enforceable rights or obligations. It can be written, oral, or implied from customary business practice. Similar with the discussion of Sir Milan. So the contract can be written, oral, or simply implied from the customary practices between the seller and the customer. So in accounting for it, revenue cannot be recognized until a contract exists. Always remember that. Company obtains rights to receive consideration and assumes obligations to transfer goods or services. And rights and performance obligations gives rise to a net asset or a net liability. then company does not recognize contract assets or liabilities until one or both parties perform under the contract. So another example here, contracts and recognition. On March 1, 2019, Margo Company enters into a contract for to transfer a product to Sun Yun on July 31, 2019. So the contract was made on March 1, and there was this agreement to transfer it on July 31st of the same year. So the contract is structured such that Sun Yun is required to pay the full contract price of 5,000 on August 31. And the cost of the goods transferred is 3,000. So Margo delivers the product to Sun Yun on July 31. So what are the journal entries should Margo Company make in regards to this contract in 2019? So here we are. First, on July 31, we debit accounts receivable, 5,000, credit sales revenue. Since we're following perpetual inventory system, we debit the cost of goods sold and credit inventory. So the facts are given here. So Margo makes the following entry to record the receipt of cash on August 31, 2019. So debit cash, 5,000, credit accounts receivable, 5,000. So when you cancel out the debit of accounts receivable and the credit, so what's left will be cash and service revenue. So a performance obligation is a promise to provide a distinct product or service to a customer. So it becomes distinct when a customer is able to benefit from a good or service on its own or together with other readily available resources. So further examples will be given as we progress. The objective here is to determine whether the nature of a company's promise is to transfer individual goods and services to the customer or to transfer a combined item or items for which individual goods or services are inputs. Illustration. Assume that Tata Motors India sells an automobile to Marquardt auto dealers at a price that includes 6 months of telematic services such as navigation and remote diagnostics. These telematic services are regularly sold on a standalone basis. Other than the automobile, Tata Motors are also selling or providing telematic services for a monthly fee. After the 6-month period, the consumer can renew the services on a fee basis with Tata Motors. The question is whether Tata Motors sold 1 or 2 products. So this is now our question. If you look at Tata Motors' objectives, it appears that it is selling 2 goods, the automobile and telematic services. Both are distinct, they can be sold separately, and are not interdependent. So illustration again here. SoftTech licenses customer relationship software to Lopez Company. In addition to providing the software itself, SoftTech promises to provide consulting services by extensively customizing the software to Lopez Information Technology environment for a total consideration of 600,000. In this case, Softec is providing a significant service by integrating the goods and services, the license, and the consulting service into one combined item for which Lopez has contracted. In addition, the software is significantly customized by Softec in accordance with specifications negotiated by Lopez. Question: do these facts describe a single or separate performance obligation? So the license and the consulting services are distinct but interdependent, and therefore should be accounted for as one performance obligation. Licensing and consulting service. So step 3, determining transaction price. So that's the amount of consideration that company expects to receive from a customer. In a contract, that is often easily determined because customer agrees to pay a fixed amount. So other contracts, companies must consider the following: variable consideration, time value of money, and non-cash consideration. And of course, consideration paid or payable to customers. So we are increasing our understanding class. So there are other contracts that companies must consider: variable consideration, the time value of money, non-cash consideration, and consideration paid or payable to customers. The underlying concept here pertains to the expected value approach. That is related to warranties before. Determining the liability for warranties. So this is what we meant by variable consideration. So variable consideration also applies to the transaction price. So price dependent on future events may include price increases, volume discounts, rebates, credits, performance bonuses, or royalties. And companies estimate amount of revenue to recognize. Just like, what is the expected value? The most likely amount. So expected value, that is the probability weighted amount in a range of possible consideration amounts. May be appropriate in a company if a company has a large number of contracts with similar characteristics, can be based on a limited number of discrete outcomes and probabilities. So if there's only one contract, so probably this one would not or cannot be applied. Most likely amount, the single most likely amount in a range of possible consideration outcomes, may be appropriate if the contract has only two possible outcomes. unlike the expected value. So we have the fact here. Peabody Construction Company enters into a contract with a customer to build a warehouse for 100,000 with a performance bonus of 50,000 that will be paid based on the timing of completion. The amount of the performance bonus decreases by 10% per week for every week beyond the agreed completion date. The contract requirements are similar to the contracts that Peabody has performed previously, and management believes that such experience is predictive for this contract. Management estimates that there is a 60% probability that the contract will be completed by the agreed upon completion date, a 30% probability that it will be completed 1 week late, and only a 10% probability that it will be completed 2 weeks late. So how should Peabody account for this revenue arrangement? So management has concluded that the probability weighted method is the most predictive approach. So on time, that is 60% chance of 150,000, around 90. If 1 week late, that's 30% of 145,000, that's 43,500. How did we get 145,000? Anyone? Let me finish. And 10% chance of 140. How did we get 145, 140, 150? Let's go back to the previous slide. So it's here. 100,000 plus the performance bonus of 50. So that is your constant. So 50 times, what is 60% of 100?
60, sir. 60.
60.
Oo.
Okay, so we have the probability here now. The amount of the performance bonus decreases by 10% per week. So under 150, can you, if you multiply 150 by 60%, what is the result?
5, sir. 5.
How much?
90.
90, sir.
90. Okay. So how did we get 145, the second, the 1 week late?
Minusan sa kuan, sir, 5,000 nga decrease.
10%. No?
Oo, 10%.
It will decrease 10% per week, reduces, right? The performance
Yes,
bonus. Okay. And finally, so 150 times 90% times 30%, correct? Do you have the same figure? Times 30%. So 43,400. The next is 50,000 times 80%. We are reducing 10. 40 plus 100, 140 multiplied by 10%. So that is the amount, 14,000. So the most likely outcome, if management believes they will meet the deadline and receive the 50,000 bonus, the total transaction price would be 150 with the outcome of 60% probability, because that is higher. Under variable consideration, companies only allocate variable consideration if it is reasonably assured that it will be entitled to the amount. Companies only recognize variable consideration if they have experience with similar contracts and are able to estimate the cumulative amount of revenue, and based on experience, they do not expect a significant reversal of revenue previously recognized. If these criteria are not met, revenue recognition is considered constrained. So the two considerations must be met, no, under variable consideration. Application of the time value of money. So we call it the timing of payment. So when contract, the sales transaction involves a significant financing component. So we need to apply TVM here. So interest accrued on consideration to be paid over time, fair value determined either by measuring the consideration received or by discounting the payment using an imputed interest rate. Company reports as interest expense or interest revenue. Okay, we have an example here. On July 1, 2019, SIC company sold goods to Grant Company for 900,000 in exchange for a 4-year, zero interest-bearing note with a face amount of 1,416,163. The goods have a cost on 6 books of 590,000. So questions: A, how much revenue should SIC company record on July 1, 2019? And B, how much revenue should it report related to this transaction on December 31, 2019? So we have the entries here. Debit, notes receivable, credit, sales revenue. And don't forget to write the explanation afterwards. Then cost of goods sold, 590. And credit, of course, inventory. Again, the explanation follows. So entry to record interest revenue at the end of the year, December 31. So you count July until December, that is 6 months. So notes receivable, 54,000. So interest revenue, that is 12%, times 1/2 times 900,000. So companies in general are not required to reflect the time value of money if the time period for payment is less than a year. But this example class, that is in exchange for a 4-year zero interest bearing note. What about non-cash consideration? So companies sometimes receive consideration in the form of goods, services, or other non-cash consideration. When this situation occurs, companies generally recognize revenue on the basis of the fair value of what is received. we have, for example, donation and gifts, or sometimes customers contribute goods or services such as equipment, labor. As I have said, companies generally recognize revenue on the basis of the fair value of what is received. Consideration paid or payable to customers. So may include discounts, volume rebates, coupons, free products or services. So in general, these elements reduce the consideration received and the revenue to be recognized. So Samsung here. Samsung company offers its customers a 3% volume discount if they purchase at least 2 million of its product during the calendar year. On March 31, Samsung has made sales of 700,000 to Arctic Company. In the previous 2 years, Samsung sold over 3 million to Arctic in the period April 1 to December 31. Questions. How much revenue should Samsung recognize for the first 3 months of 2019? So debit accounts receivable, $679,000. Credit sales revenue, that is 700,000 times 3%. So the revenue is actually reduced by 21,000 because it is probable that the company will provide this rebate. So question again, how much revenue should Samsung recognize for the first 3 months of 2019? Assuming Samsung's customer meets the discount threshold, Samsung makes the following entry. Debit cash, still the same. Credit accounts receivable. On the other hand, if Samsung's customer fails to meet the discount threshold, Samsung makes the following entry upon payment. Debit cash 700, credit accounts receivable 679, and credit sales discount forfeited, which is 21,000. So sales discount forfeited is reported in the other income and expense section of the income statement. Did you get me? Sales discounts forfeited is reported in the other income and expense section of the income statement. So we are now into allocating transaction price to separate performance obligations, which is step 4. So that is based on the relative fair values. Best measure of fair value is what the company could sell the good or service for on a standalone basis. If not available, companies should use their best estimate of what the good or service might sell for as a standalone unit. So the allocation approach, under adjusted market assessment approach, the implementation here is evaluate the market in which it sells goods or services and estimate the price that customers in the market are willing to pay for those goods or services. And that approach also might include referring to prices from the company's competitors for similar goods or services and adjusting those prices as necessary to reflect the company's cost and margins. So under the expected cost plus a margin approach, forecast expected costs of satisfying a performance obligation and then add an appropriate margin for that good or service. Residual approach. If the standalone selling price of a good or service is highly variable or uncertain, then a company may estimate the standalone selling price by reference to the total transaction price less the sum of the observable standalone selling prices of other goods or services promised in the contract. So we'll be having examples again here. So under allocating transaction price, because this is the gist of how do we allocate. 100 Company is an established manufacturer of equipment used in the construction industry. Handler's products range from small to large individual pieces of automated machinery to complex systems containing numerous components. Sometimes I have to stop talking here because I always get this unstable internet connection. So unit selling prices range from 600 to 4 million and are quoted inclusive of installation and training. So they are quoted inclusive of installation and training. The installation process does not involve changes to the features of the equipment, okay, and does not require proprietary information about the equipment in order for the installed equipment to perform the specifications. Just like here class and SLSU, when we order this box type air conditioning unit or the split type, we only pay for the cost, but we never bothered allocating a cost for the installation. And I hope this year, when we do the budgeting, they would already include it in our budget. Because how can that particular unit operate when it is not properly installed? And that is somewhat being left out when we prepared the previous budgets in the past years. And I think Sir Dan will correct it this year. So the unit selling prices ranges from 600 to 4 million, and they are inclusive of installation and training. So Handler has the following arrangement with Chai Company. Chai purchases equipment from Handler for a price of 2 million and chooses Handler to do the installation. Handler charges the same price for the equipment irrespective of whether it does the installation or not. Some companies do the installation themselves because they either prefer their own employees to do the work or because of relationships with other customers. The installation service included in the arrangement is estimated to have a standalone selling price of 20,000. So the standalone selling price of the training sessions is estimated at 50,000. Other companies can also perform these training services. So Chai is obligated to pay Handler the 2 million upon the delivery and installation of the equipment. Handler delivers the equipment on September 1, 2019 and completes the installation of the equipment on November 1, 2019. So how many months? September, October, so 2 months. transfer of control is complete. Training related to the equipment starts once installation is completed and lasts for 1 year. The equipment has a useful life of 10 years. Question under step 3. What are the performance obligations for purposes of accounting for the sale of the equipment? So, handlers, the seller, its primary objective is to sell equipment. So the other services, installation and training, can also be performed by other parties if necessary. As a result, the equipment, installation, and training are 3 separate products or services. And each of these items has a standalone selling price. They are not interdependent. So either the buyer can get it from handler or they can get it from outside or other firms. So the total revenue of 2 million should be allocated to the 3 components based on their relative standalone selling prices. In this case, the standalone selling price of the equipment is 2 million, the installation fee is 20,000, and training is 50,000. So the total standalone selling price therefore is 2,070,000. And this is how we do the allocation. So equipment, 2 million divided by 2,070,000 multiplied by 2 million. The installation, that's 20,000 over 2,070,000 times 2 million. We are prorating it, class. Training, 50 divided by 2,070,000 times 2 million. So this is now the entry. So question, if there is more than one performance obligation, how should the payment of 2 million be allocated to various components? So earlier we already calculated it. So debit cash, 2 million. Debit cash, 2 million. Service revenue installation, 19,324,000. Unearned service revenue, why? Because it takes more than 1 year to complete the training, and sales revenue of 1,932,000. Then the usual cost of goods sold. So debit cost of goods sold and credit and credit inventory class. There was a call earlier from Ma'am Ritumi. So handler recognizes revenue from the sale of the equipment once the installation is completed on November 1, 2019. In addition, it recognizes revenue for the installation fee because these services have been performed. So handler recognizes the training revenues on a straight line basis starting November 1, 2019 or 4,026, that is 48,309. That's why earlier our original entry was according to unearned service revenue of 48,309. So we divide it by 12. That's good for 1 year. So we only recognize the first month. So as of December 31, this is our adjusting entry. For a total, 4,026 for November and 1 for December. So this is a case wherein we don't recognize all the time it's a revenue. That's why we have an asset liability agreement here. So handler recognizes revenue at December 31, 2019 in the amount of 1,959,743. So that's a total of 1,932,367 plus 19,324 plus 8,052. Handler makes the following journal entry to recognize the remaining training revenue in 2020, assuming adjusting entries are made at year end. And this is just for the training class. So unearned service revenue, to make it complete, so 40,057. So from the original unearned of 48,309, so we recognize 2 months in 2019. So the balance is for 2020. So recognizing revenue when or as its performance obligation is satisfied, that is step 5. Company satisfies its performance obligation when the customer obtains control of the good or service. Change in control indicators. Company has a right to payment for asset. Company has transferred legal title to asset. Company has transferred physical possession of asset. Customer has significant risks and rewards of ownership as given in the Bean and Tyler relationship earlier. And customer has accepted the asset. So these are the 5 preconditions. We call it the change in control indicators. So recognition revenue from a performance obligation over time, it measures progress toward completion. So method for measuring progress should depict transfer of control from company to customer. So always remember, go back to the 5 preconditions earlier. And then most common are cost to cost and units of delivery methods. Then the objective of methods is to measure extent of progress in terms of costs, units, or value added. So we go back again. Each performance obligation is satisfied under step 5. So under step 1, identify the contract with customers. The description is a contract is an agreement that creates enforceable rights or obligations. Implementation, a company applies the revenue guidance to contracts. Step 2, identify the separate performance obligations in the contract. Description: a performance obligation is a promise in a contract to provide product or service to a customer. A performance obligation exists if the customer can benefit from the good or service on its own or together with other readily available resources. Implementation: a contract may be comprised of multiple performance obligations, not only one. So the multiple performance obligations were already explained to you earlier, especially the handler example. Accounting is based on evaluation of whether the product or service is distinct within the contract. If each of the goods or services is distinct but is interdependent and interrelated, these goods and services are combined and reported as simply one performance obligation. So this one is plenty long earlier in our discussion. Determine the transaction price. How? So transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring of goods and services. In determining the transaction price, companies must consider the following factors: variable consideration, earlier, expected value, the time value of money. Actually, we don't apply it if the contract is just 1 year or less. Non-cash consideration and consideration paid or payable to customer. So allocate the transaction price to the separate performance obligation, that is step 4. Description: if more than one performance obligation exists, allocate the transaction price based on their relative fair values, as given in the handler's example. The best measure of fair value is what the good or service could be sold for on a standalone basis or standalone selling price. Estimates of standalone selling price can be based on adjusted market assessment, the expected cost plus a margin approach or a residual approach. And step 5, recognize revenue when each performance obligation is satisfied. Description: a company satisfies each performance obligation when the customer obtains control of the good or service. Implementation: companies satisfy performance obligations either at a point in time or over a period of time. Companies recognize revenue over a period of time if one of the following criteria is met. So customer receive.
Saba, Krisilda, saba.
Uy, Coco. Wala, mag-answer.
Ay, sir, uy.
Lagi. Ni ang hati kaputol sa connection
Saba,
siguro.
saba. Saba, Krisilda, saba.
Coco.
I'm here now, Priscilla.
Isa.
So the following criteria is met: customer receives and consumes the benefits as the seller performs, customer controls the asset as it is created, or company does not have an alternative use for the asset. So those are our 5-step revenue recognition process. So before we continue, let's check our understanding class. Okay. Are you seeing the screen?
Yes, sir.
Okay.
Yes.
Let's apply first because this is a very long chapter. Okay, number 14. Can you read? Griselda?
Sir,
Oh, read number 14.
Ali Corporation is evaluating a revenue arrangement to determine proper revenue recognition. The contract is for construction of 10 speedboats for a contract price of $400,000. The customer needs the boats in its showrooms by February 1, 2020. For the boat purchase season, the customer provides a bonus payment of $21,000 if all boats are delivered by the February 1 deadline. The bonus is reduced by $7,000 each week that the boats are delivered after the deadline until no bonus is paid if the boats are delivered after February 15, 2020. Ali frequently includes, excuse me lang, at saka, includes such bonus terms in its contracts and thus has good historical data for estimating the probabilities of completion at different dates. It estimates an equal probability of 25% for each full delivery outcome. What approach should Ali use to determine the transaction price for this contract?
Yes, what is the approach? For a while, class. Okay, what is asked here? What approach should Ali use to determine the transaction price for this contract? So we'll be applying here the probability weighted estimate, just like in the given example earlier. So first, there's a 25% chance of 421,000 if by February 1. So what is this in February 1? Because we will multiply the percentage. So how much would it be by February 1? Because as we discussed earlier, the probability weighted method is the most predictive approach for estimating the variable consideration, just like in this number 14. So the customer provides a bonus payment of 21,000 if all boats are delivered by the February 1 deadline. So there's a 25% chance of 421,000 if the boats are delivered on February 1. So you multiply 25% times 421.
105,250,
Hold
sir.
on to the figure. What about on February 8? So the bonus is reduced by 7,000 each week
Yes,
that the boats are
414,000.
delivered after the deadline until no bonus is paid if the boats are delivered after February 15.
So 414,000 na naman, sir, so 25% times 414,000.
How did we get 414,000?
Reduced by 7,000, sir,
Okay, that's
from
good. So you
421.
multiply it by 25%.
25%,
So,
103,500, sir.
okay, so hold on again to the figure. What about by February 15?
407,000
407,000 times 25%.
25%,
And
101,750.
Oh, 101, 750.
then after February 15, 400,000 times 25%. So they have an equal
Yes, sir.
probability.
Yes, sir.
But the performance bonus will be reduced. And again, we reach to zero after February 15. So what is the total amount or the total transaction price? So you add 105,250, 103,500, 101,750, and 100,000.
For 10, 500, Mr. 410, 500.
410,500.
500. Yes,
The
sir.
rest are simply, you can refer to the text. So let's go to number 19. So here, each element has separate standalone. So what about number 19, class? Who's going to read it? Annalie?
Yes, sir. Foreman Corporation Company is a full-service manufacturer of surveillance equipment. Customers can purchase any combination of equipment, installation services, and training as part of Foreman security services. Thus, each of these performance obligations are separate with individual standalone selling prices. Lapante,
So what is the allocated price for the equipment? What's the allocated price for the installation? And how much is the allocated price for training?
yes, sir. 90,000, 7,000, and 3,000 respectively. So how should the transaction price be allocated?
So the total here is 100,000, right?
Yes, sir.
And then you have to allocate the total revenue of 80,000
Yes, sir.
for the total sales price. Okay, give me the amount for the equipment. Give me the amount for the installation, training.
Equipment is 90,000. Ang ijang allocation na, sir?
Yeah.
Allocated transaction price na, sir, sa equipment installation.
How much?
So, since ang equipment, sir, is 90,000. So, 90,000 divided by 100,000
Times?
80,000. So, 72,000, sir.
Okay, and then installation?
Installation, 7,000 divided by 100,000, 7%. So, 7% times 80,000. 5,600, sir. Sa installation, sir, 5,600. So, sa training,
The training,
okay,
how much?
3,000. 3,000 as a training, so divide by 100,000. 3%, 80,000 equals. Okay, 2,400, sir.
Total.
So 72,000 plus 5,600 plus 2,400 equals 80,000. 80,000, sir.
Still, yeah, at 80,000.
80,000.
Okay.
Yes, sir.
So did you get it? So those are just applications class of what we discussed so far. So let's move to brief exercises 18-1. Chrislyn? Where's Chrislyn? I saw her earlier. Makapanas, Mary Joy.
Yes, sir.
Okay.
Lino Computers manufactures tablet computers for sale to retailers such as Fallon Electronics. Recently, Leno sold and delivered 200 tablet computers to Fallon for 20,000 on January 5, 2019. Fallon has agreed to pay for the 200 tablet computers within 30 days. Fallon has a good credit rating and should have no difficulty in making payment to Leno. A. Explain whether a valid contract exists between Leno Computers and Fallon Electronics. B. Assuming that Leno Computers has not yet delivered the tablet computers to Fallon Electronics, what might cause a valid contract not to exist between Leno and Fallon?
So we answer first A.
Explain.
So for instance, number 1, the contract has a commercial substance because Fallon Electronics agreed to pay cash for the computers, right? Correct?
Yes, sir.
Okay.
Yes, sir.
So what about step 2? What is step 2?
Identify the performance obligation in the contract.
So what is the obligation here? The commitment to deliver, right? Who's the seller
Yes, sir.
here?
Lino.
Lino. Okay. So we met. Identify the separate performance obligations in the contract. In this example, Fallon Electronics has made a commitment to purchase the computers, and Lino has approved the selling of the computers. Actually, the computers were already delivered, right? Within 30 days. What about step 3? Determine the transaction price. Is that step 4? Step 3.
Step 3.
So in this case, we have to identify first the rights of the parties. Fallon has the right to the computers and Lino has the right to payment because Lino is the seller. And then number 4, there's
Allocate
no other transaction here, no, except for the delivery of the computers.
computers. Yes.
That is 20,000 for 30 days, within 30 days. And we believe that Falcon has a good credit rating performance. No? So Lino believes the company can collect the amount. So for item B, so if what might cause a valid contract not to exist between Lino and Fallon, of course, if there is no performance
No
between
payment.
from any of the two contracting parties, so that will become invalid. And if the buyer has a poor credit rating, then naturally it will defeat the purpose. Okay, what about number 2? Christine. Kaka. Riami, Algeria. Can you read? Oh, she got lost. Oh, continue, Crisilda. Crisilda. For number 2, 18.2.